If you're opening an ISA, here's 6 costly mistakes you need to avoid. Lots of us have individual savings accounts or ISAs, which allow for up to £20,000 of tax-free saving and investing each tax year. But when setting these up, we tend to make some very simple mistakes that can cost us thousands down the line. Now, I've worked in the investment industry for 15 years and I've heard lots of these over that time. So today I'm going to run through 6 really avoidable mistakes when you're setting up your ISA. Don't forget to subscribe to the channel and turn on notifications. Okay, mistake number 1. Too many people seem to go for cash. Now, when you look at the ISAs that are opened each year, very broadly, around 2/3 are cash ISAs. So I get the arguments for this. You get a bit of a return, and importantly, its value is stable. So if you need the money, it's readily accessible. And on the other hand, investments are risky, aren't they? They can go down in value. But there is a flip side to this argument. Importantly, inflation erodes the value of cash over time. So £10 in 10 years' time is going to be worth less than £10 today. What's more, investment risk can be managed using diversified products like ETFs and funds, and these offer a way better chance of significantly growing your money over longer periods of time. This is because investments plug your money into economies and businesses, and you will share in their success. Yes, economies will go through tough times and profits and the value of shares will suffer for a while. What history tells us is that they recover and share prices will carry on climbing. Look at this chart from Quilter. We can see here the long-term returns of equities, which is just a posh name for shares, as well as cash and bonds, which are a type of loan and from an investment risk perspective sit somewhere between cash and shares. What you can see is that the value of shares bounces around a fair bit. There's a fair bit of volatility. And at times, the returns of shares falls below that of cash. But over the long run, my God, do they absolutely destroy the returns of cash. Now, of course, you need some cash savings as a buffer. And what's recommended is you have between 3 to 6 months of full living expenses as an emergency fund. But beyond this, I would suggest putting your long-term savings into the stock market. Mistake number 2, new investors start with individual company shares. New investors quite often start off by buying individual company shares because they've heard of certain companies like Nvidia and Coca-Cola and Nike, and they want to get involved. But this is very risky. You're jumping straight into the deep end of risk because share prices are very volatile and ultimately their value can go to zero. Diversified products like ETFs and funds spread your risk amongst lots of different investments, like lots of different individual company shares. So if there's a problem in one, the others will cushion that blow. It means your returns are likely to be less extreme, both up and down. Problem with this is it's not as exciting. So one thing that investors do is they blend both approaches. They have a core of diversified products that kind of hoists them to their financial goals. And then around the edge in these little satellite positions, they invest much smaller amounts of money in the sexy stuff like individual stocks or crypto assets so that they're not taking too much risk in any one position. Mistake number 3. People don't often take enough note of costs. Now, there are 2 main costs with investing. There's the platform or broker fee, and then there's the cost associated with your investments, like your fund or ETF costs. Fees are usually charged as a percentage of your total assets, so differences between brokers or investment products can seem quite small. But actually, these small differences have a massive impact over longer periods of time. You just need to look at this chart from Vanguard, which is a provider of really low-cost investment products. Make sure you dig down into the charges that you're on the hook for and make sure you keep them as low as possible. Mistake number 4, people tend to overtrade their portfolios. It can be very tempting to trade in and out of products when, the market is churning, you're hearing some news coming through, you've read something about an exciting new asset class, some random influencer is telling you to buy something. But the best thing to do is to resist this and actually to really just forget about your portfolio. This is because not only does trading often come with cost, depending on what investment you're buying, which can obviously impact your returns, it also comes with a type of behavior. And that is to move in and out of investments at inopportune times, particularly when the market is panicking and you're feeling like you want to cut your losses. But importantly, you can end up missing the best days in the market, which often come after the worst. Again, using the same report from Quilter, we can see that missing those best days can absolutely annihilate your returns. So ignore the noise. Journalists love talking about markets, particularly when they're panicking, not really when they're doing well. Ignore all of that. Just keep going. Mistake number 5. They often think they need sizable chunks of cash to get going with investing. It's actually not true. You can pretty much get going with a single £1. Actually, if you're a bit nervous about starting, one approach is to drip feed your money into the market, which share dealing platforms often make really easy. And it'll get that savings habit going, and you'll get a feel of the ups and downs, the soap opera that is the stock market. Mistake number 6, people often get impatient with their investments. Now, the best thing that you can do is leave your money for as long as possible. As we saw in that first chart, a lot of the gains came right at the end. And that's because compounding is doing a lot of the heavy lifting, and that force, this magnificent force, gets more and more powerful over time. And remember, if you're getting a bit nervous about an investment that's done particularly well, you don't need to sell the whole thing. You can just trim some of your gains and roll that money into some newer investments. This is called rebalancing your portfolio. Please subscribe if you like what you're seeing, and if you've got any questions for me, please leave them in the comments box below.